welcome back to We Hate Money. I believe this is episode 4, official episode 4, and we have the bonus episode. That's what's throwing me off. So, yeah, we're back. How you going, Wiz? What's going on? What's the plan?
You fuck the plan, Arnie. That's the plan. There's never been a plan. That we've been lied and deceived, but
That's it.
that's okay because we hate money, so we're good to go. Yeah, 4 episodes of this feeling our way through whatever's going on these days, whether it's the economy, your portfolio's flat for the year. I mean, we're trying to figure it out too.
That's what we're doing. We're just one step at a time. We're figuring it out. We're seeing what's going on, and we got a little bit to cover. I mean, obviously, a bit of a quiet week because we had you guys had the holiday. That was a Friday and a Monday holiday, was it?
I think for us it was Monday, but I think there was a maybe banking holiday last Friday for the UK. I don't remember.
Yeah,
Maybe it was the week before. I get my holidays confused. But I didn't have to work yesterday, so here
that's the way,
I
mate.
am.
Everyone loves a long weekend. You can't argue with that, eh?
Yeah, no, not at all. But
So
yeah,
a few things going
what?
on.
Yeah, let's.
Before we dive into it, let's just say if everyone wants to give us a like, comment, subscribe, click the bell, and on YouTube, and you'll be notified of when we upload our podcast. But this week we're going to talk about rising yields in the bond market. We're going to talk about our personal, general in nature opinion on equities. We're going to talk about alternative asset classes, and but before we do, Wiz, you were mentioning to me that a dangerous word has been bandied about. Stagflation. I forget what network you said it was on. What were they
It was
talking
one
about?
that was on a MSNBC. You know, it's always just they said it, and they're just looking at the data as it is right now. So, but they're kind of seeing a scenario where there could be stagflation. Would not be the best scenario for the economy. I know the Fed is doesn't want stagflation. So we've had those revisions in job numbers, right? And that's not good to go back several months, take 100K out of each month of jobs. I mean, jobs don't work that way. So the numbers we've been getting, you can't trust them. And the revisions are getting to be a bit drastic, I feel. Um, Especially if it's 2 months in a row of revisions, they do. I don't know about that. I mean, something feels wrong, and it is politics. You know, perhaps there's a political reason for overestimating those numbers, but we'll find out. It just gives to me false expectations.
Absolutely. I wonder how the numbers are gathered in the first place. I've never really looked into that process. Just before we head on and talk more about this, just for the listeners, in case you're not aware, stagflation is the definition is persistent high inflation combined with high unemployment and stagnant demand in the economy, or perhaps it's better characterized as like a slow economic cycle with high unemployment and high inflation. So at the moment, America has very strong employment. And that's, I guess, and obviously high inflation everywhere. But I guess the fear is that the high inflation sticks around, becomes sticky, people start losing their jobs, and yeah, we just see a slowing of growth in the economy. So, yeah, back to the numbers. The numbers, if it's politically motivated, Wiz, I wonder who has their fingers in those pies. Like who would be doing that, or is it just a case of the numbers are estimated and then they're sort of confirmed after the fact?
Well, it's the Bureau of Labor Statistics, so we know that they run the numbers to promote expanding their budget. So whatever that narrative is, almost every department in the federal government sort of tends to do that because they have to justify getting more money the next year. So that with that in your back pocket, there's sort of a goal to make them seem like they're useful. I would say the political motivation is to try to, and by the way, it's not a party politics thing for me. Every administration, regardless of party affiliation, wants their economy to look good. And so there's an encouragement to try to overestimate probably what those numbers are. Uh, it's not like the ADP report, where they kind of pull those numbers out of what's reported to them. It's more of the collection process is supposed to be more trustworthy, but I have lost trust over the past 6 months.
I am
So
100% with you, mate. So it's just beautiful bureaucracy at work. Beautiful bureaucracy. Where,
yes,
yeah, I understand that all too well. The mechanisms of government. So that's interesting. But yeah, yields. So Treasury yields on the up and up. The dollar climbed to a 6-month high this week, and as a result, government bonds under pressure. So I think the greenback highest level since March, and at the same time, the 10-year Treasury yield rose 0.1 percentage point to 4.27. So yeah, as those yields rise, the bond prices are falling. King last week said doesn't see a bond he doesn't like at the moment. I know the Federal Reserve has said that they're thinking about keeping interest rates on hold. What do you think, Wiz?
I think it's becoming a messy situation like we saw at the end of last year. And I don't think it's going to end well for people who are relying on bond values from 2 to 3 years ago. So if they've been holding those as collateral, to offset any cash reserves that they've got, they're kind of in trouble. Because if there's any movement of money that requires them to sell those bonds, not hold them to maturity, mind you, but to sell them, that to get some sort of cash equivalent out of it, they are on the back end of that. Now, that's what sort of led up to the problem we saw in the gilt market, for example, in the UK, and then in our own banking industry here in the US, where that cash collateral for those bonds just wasn't enough. And there was sort of like a staged run on the banks. And I say staged because the actual fallout from those banks was never going to be severe enough to cause a catastrophic, impact to our banking system today. But it was never over back in the beginning of the year. So we could see that resume if yields continue to persist higher.
Yeah, I think you've hit the nail on
And
the head there. Oh, sorry to cut you off. Go on.
Well, and that plugs into the fears about jobs, right? Because if people are losing their jobs, or there's not enough growth in jobs to keep up with the persistently high inflation. Now, inflation isn't as high as it was in the middle of last year, but it could move higher again. Oil's already moved up with the dollar, which is somewhat suspicious in itself, because you don't normally see those moving together. So there's some sort of very strong fundamental reason for oil going up with the dollar. It's stronger than that relationship historically would be, or normally would be. So that's a cautionary thing as well. And if oil keeps going up, we all know winter isn't far away. Fall definitely is almost here. So higher fuel prices, higher oil prices, a stronger dollar, and higher yields. It just sounds like one way or the other, one of these is lying, or they're all moving higher, and there's going to be a catastrophe for the working class. So I think stagflation looks more possible if unemployment continues to go higher, or at least not drastically higher, continues to to build steam, and we don't see as much growth. And that's where you start to lose money. People lose their spending because they got to draw more cash out. They go to sell more equities, because maybe they're retired, right? And they still need more cash to afford just to live. So we could see a lot of scenarios where people maybe are pulling more money out of their retirement accounts, and that may not be a good omen going into next year.
Yeah, well,
So I think October's still my month.
yeah, you called it early October. I'm not as certain on October, but everything you're saying, I don't really have much to add. I'd like to echo a few points there, but aside from America, we know that the Eurozone economic data has not met expectations. We spoke last week about China and the trouble they're facing. I know that just anecdotally, well, not anecdotally, but as an aside from this macro conversation, Country Garden, the developer that we discussed, were able to defer payments of the bond that was giving them trouble. I think they've got other ones as well, and they have to pay the coupon still, but they've extended the principal repayment out till I think 2026. I might be getting that wrong, but yeah. So the growth in China, the growth in the Eurozone, the growth in America, we are worried about it. Pundits are worried about it. Inflation persistent. If unemployment goes up, will we see stagflation? It's possible. And you were mentioning before the cost of oil, the cost of energy, that's going to stay probably persistently high because OPEC plus, the war in the Ukraine and Russia still rages on. That has an effect on all of that. So, yeah, it's a worrying time, Wiz. And then sort of rounding this back to the bonds and the collateral, are organizations going to be able to service their obligations and pay? If they have to sell their bonds to get cash, are they going to have to sell them at a hefty discount if they can't afford to hold them to maturity? Are we going to see a spiral and a potential collapse? And on top of that, we haven't even really discussed commercial real estate, which you and I have talked about a little bit about before. So that's another little looming catalyst. So I think and that's sort of, not that I want to wrap up this conversation, still have thoughts if you've got them, but that kind of leads us to our next topic, which is what's going to go on with equities. But yeah, do you have any final thoughts about that?
For me, I think with housing, just to touch on it a little bit, I think we're seeing. I think because the housing market in the U.S. is a bit different than every other housing market in the world. You see areas sort of start to pick back up and selling and buying, and it seems like prices are starting to go back up a bit. And I can't remember if it's because new or used prices are starting to, new inventory versus existing inventory. I believe that there was a price disparity and that's sort of resolved. So I know that happened with cars, but we're starting to see some overall pricing pick back up, which is a sign that there's still enough money out there for people to buy homes, even at these higher rates. And some of these housing rates are what, like 7-8%?
Yeah, they're big.
I mean, that's a lot. That's a lot of cash on $700,000, $1 million homes. That's sort of pushing the average up there. So I'm not sure where people are going to find 15, 30 years worth of payments at that big of a payment. It's I don't know. I feel like something's wrong here. I'm not sure what it is.
I think we're sort of waiting. I think we're waiting for the other shoe to drop. I know that out of Australia, I mean, our market is tiny compared to the markets we're discussing, but our Federal Reserve chair, who's on the way out, in his last sort of speech said, we're experiencing below trend growth, and our rates are the highest they've been in a long time. They expect to maintain those rates, similar to what your Fed chair power set at Jackson Hole. And there's potentially a few more hikes in the future if required to combat inflation. So, yeah, it's just, I don't know, mate. I feel like markets have shown incredible resilience to this point. Will it continue? It's hard to see how unless earnings pick up.
It that's kind of I think where that other shoe is going to drop, and that's with are we going to see more stagnation, and is inflation going to be stickier than anticipated? And that's kind of where people have been waiting, to see. And we had a lot of impatience this year. People just sort of diving all in because they don't want to wait anymore. They don't have they see opportunities and they're going to take them. It's worked out for some people, not so much for others. But right now, if you were buying in the beginning of the year, you don't really have a reason to sell yet. You have no reason to question what you bought at. So I kind of see it as still just waiting, feeling out where things are going. But from where I can see, I don't see this ending well unless there's some sort of resolution that comes out of yields, going down, and the economic activity sort of resumes. Maybe not as hot as we used to be, but that scenario just seems unlikely to me, though.
Yeah, well, I feel like where my head's at with this, I also think I will wait and see on equities, except for how I invest. Like if I see something I like at a good price, I'll invest regardless. But at a macro level, I think something like SPY or QQQ is due to come down for a pullback for all the reasons that we discussed. I would be waiting and seeing if I were going to be considering those as investment vehicles.
Yeah, definitely the Qs, because they're supposed to be really yield sensitive. They have not behaved that way.
No, they absolutely haven't. No, you're spot on, mate. I think it's sort of like leads us to our next point. We've structured this beautifully because you and I were thinking like alternative asset classes to equities. Obviously, we've already discussed bonds, and I think an allocation to bonds makes sense in some way, shape, or form. But something like real estate, perhaps, either through something like a REIT, or if you're going to, just go buy investment properties, or get a piece of them. What do you think, Wiz?
I think if you're looking at, well, in the U.S., there are two different markets, at least for commercial versus residential housing. So commercial property is viewed as a different market. That in the U.S. was a bloodbath earlier this year, and I don't know if they've got a reprieve because I don't really follow commercial too much. They were being disproportionately affected, mostly because the working from home didn't do well for them. Kind of, it's interesting to kind of grapple on too as well, because I know they're also affected by yields, but it's possible there's more downside to come for them. So where people are thinking that maybe the bloodshed's over, it may not yet be. So, but is it a bad time to buy? It may not be. So you have to kind of look at it because they had a really bad year last year, and it could be that there's maybe some opportunity. But I would say if you hadn't bought already, may not make sense to now. It's a gamble. It's more of a gamble than an educated guess.
Yeah, I think it's also about like your exposure. Like, would I buy into a REIT now? There's some REITs that I might consider buying into. But obviously we just discussed like the risk of the commercial real estate. I think I'd be looking for ones that are exposed to it and waiting and seeing to buy on those. But then talking about alternative asset classes, bonds, fixed income, if I wanted to buy, or if I wanted to get some exposure to some corporate bonds, to some government bonds, to some fixed income ETFs, I would definitely be allocating heavily. Like, this is general in nature. Do your own research, do your own due diligence. But I would be definitely thinking about allocating some money to fixed income. Whereas, the last 10 years, have you or I
Oh,
been
fixed income is crap. Yeah.
exactly?
You lost money in fixed income. Uh, um, but yeah, now rejoice, right? Rejoice, my savings bros, because
Rejoice.
the interest yields have come to save you, but they haven't come to your local banks. That's a thing to keep in mind there. So investment vehicles, where you can get good yields, are going to be preferred. Um, but yeah, I would say it's not bad to look at them to hold them. So if you're actually buying the underlying bonds to hold them to maturity, or at least the funds that you're participating in, right? Maybe a good idea to start doing that. It's never a bad time to hold bonds at 4 to 6% over the next several years. And of course,
Absolutely agree.
so yeah, I mean, you're getting close to beating the average anyways for the S&P. So, and there's no risk. So why would you not see that as appealing? That's the other problem with this is we have so much cash chasing equities. It's like, well, fixed income is sort of this, gray rhino, so to speak. Was it a black rhino, as they say in the Asian markets, just sort of sitting in the back, waiting. Everyone can see it, but it hasn't hit just yet.
Yeah.
So it's there's that danger out there for people who are bullish equities. You know, if you can't guarantee a higher return, then fixed income is going to steal all your cash. So that's another complexity to this scenario that we're seeing unfold. I would think if the yield curve were to steepen from here, it would be wild, right? Because that would mean that you're not going to have a large drop in the short part of the curve. So you could see maybe it retreat closer to 5% from six, from 6 earlier in the year, get closer to 5, maybe go under. But then the long side of the curve is going to go above that. And how high is that going to go? It's absolutely could be disastrous.
I think you're spot on. Just just touching on some of our favorite stocks that we talk about. Again, general in nature, Playboy in the last session, down another 2.29%. So I continue to get crushed on that. I'm patiently waiting to hear some news about them selling Honey Birdette, because that should be a catalyst. SoFi, which I haven't bought any of this, but I'm still thinking about it. It's at 8.75. It was down almost 0.5%. Actually, if you include after hours, it was down more than 0.5%. And Nvidia, it was up 0.8%, and it's at $485.48. So that one continues to grow. But there's been an interesting narrative about Nvidia. I don't know if you've seen some of these videos on Twitter, X, about this CoreWeave customer. Have you seen that, Wiz?
Oh, I haven't. I've been avoiding the Nvidia propaganda.
Well, let me give you a very, very high level overview of what this is. So there's been a lot of YouTubers, a lot of X content creators who are delving into how Nvidia got such a huge beat. And there was reports, and now I might be getting this a bit wrong, but just, we don't fact check here at We Hate Money. But yeah, so predominantly most of the sales that drove this huge revenue beat were from a customer called CoreWeave. And CoreWeave apparently is funded by some hedgies. I forget the name of them right now. You'll be able to look it up. Who were directly involved with the 2008 housing crisis, where they were on one side of the trade responsible for creating the CDOs and putting them, the mortgage-backed securities, and putting the lower rated collateral into those CDOs. And they were also on the other side of the trade, heavily shorting the market. So, but they managed to get away with that scot-free. And anyway, this is the mob who is now funding this CoreWeave who bought $2.3 billion worth of those A100 chips from NVIDIA, using the same chips as collateral to get that money. Now, that sounds convoluted. I haven't explained it very well. But yeah, there's alarm bells ringing here because a lot of people have jumped onto this news story and sort of said, this seems shady. We want to do a bit more digging. So yeah, I'll leave it at that. Wiz, you can have a look at it as well. Maybe we could discuss that again next week.
Well, I will say that the problem with the orders that NVIDIA is getting, the volume of orders, is those orders don't necessarily get fulfilled. Like we saw it happen back in 2001 with Cisco, right? Where they had all those orders and then they were canceled. So you can have a lot of orders that are anticipated, but they don't always play out. So it is suspicious just from how you're describing it. I mean, it would just tell me if I was going to put all my money, it would not be in NVIDIA.
God, no. I wouldn't. Like we said a couple of pods ago, man, I'm not touching NVIDIA with a 10-foot pole. And like you
Yeah.
prudently advised, actually, you didn't advise, it's general in nature. Like you prudently pointed out to the pod, you know, if you want to catch a move on NVIDIA, now is not the time. Wait till it comes off a bit. There's still plenty of runway on the downside.
It's not, people want to strike gold, and I get it. But and there was opportunity there to do it. You know, honestly, you could have gotten lucky. Because I don't know about any technicals or indicators that would have really said, hey, this is the time to short, do it now. It's on too short of a time frame for me to be confident in. And you have to be really moving in as a day trader and locking in those plays. And that's fine if you do that. But it's also because it's on a shorter time frame, there's the possibility for violent turnarounds. And we did see that. And we've been seeing that sort of knee-jerk gapping and grabbing, and then, you know, filling the gaps the next day, moving 8% in one day. And that's kind of how you can make a lot of money, and it's how you lose a lot of money. So definitely, you know, if you're trying to swing it, there's going to be an opportunity for you. It just may not be right now. And man, 485 still. That's impressive. It looks like it's, you know, if you ask me about it, Arnie, it sounds like it's consolidating for another move.
I agree.
And whether that's to the upside, to the downside, maybe further consolidation as we get towards this month's OPEX and see what the option expiration kind of holds for us. We'll find out, but it's exciting to say the least. I love it.
Yeah, it
I
is
love
exciting.
Yeah, it's pulling everybody in too. I like it when people are looking in and digging into things and realizing maybe this is a trap, maybe this is a scam. Even if it is or it isn't, it's great to have the conversation happening because we need more eyes on markets. They're so large and they're so opaque. There's so much fraud that happens all the time. It's astounding.
It is. It really is, bro. And I just before we wrap up and say goodbye, and I want to put this on the record again, general in nature. Do your own due diligence. But one particular ticker I have been paying attention to for the last little while is Vici. It's a real estate investment trust, and I'm not going to buy it, Wiz, but if there is a big crash that comes, like we've been talking about, off one of the back of these catalysts, and this hits an attractive valuation, that's one that's right at the top for me. So just putting that on the record.
And you know, if you are looking for a buy, and if we do have a big correction, one you may want to consider buying with both hands is Chipotle, CMG.
Ooh.
That is a machine of a company. They smash pretty well. You know, I would not sit idle on a big dip in that. So I would see it, you know, if there's a crash, right, quote unquote crash. I mean, it could happen over years. If it ever gets back down to below 1,000, to me, it's an automatic buy. I mean, there's no reason not to buy it there.
I just put
And
it
then
on my watch list. On my watch list.
yeah, you may have to be patient, but I don't think you'll have to be too patient with it. So you may not be waiting 30 years, right? But I feel it would be an absolute buy. And the problem I have with McDonald's, which would be in the same category, is they have a lot of debt. And people say it's real estate debt. And I'm like, yeah, but not all of it. And I would be more apt to buy CMG Chipotle than MCD McDonald's. So I would say that's more preferred if you are looking at something. That just because right now it's trading around 1900 or so, and I feel it's just way a bit much right there. But Monster is another one, the energy drink company. They're a machine of a company as well, like pure profit for them. So you definitely look out for those brand names, common names, because they are definitely worth the buy in a downside correction. And then you've got, of course, the oil companies. They will all be worth somewhat of an allocation too, because you're always going to need plastics. You can't live off recycled plastics forever. So you're going to need new plastics as well. You're going to need lubricants. You're going to need that kind of stuff. It's going to be parts of the world that really can't 100% electrify. They'll rely on oil companies, heating oil, that kind of.
I mean, Wiz, I think you've hit. This is maybe a pod topic in and of itself, right? But if you think about the different types of oil from light to dark and the refinery process, petrol or gasoline, as Americans call it, is only one function. And even though that might be going away over the next 30 years, you've still got jet fuel, kerosene, heating fuels, diesel fuels, industrial fuels for shipping, waxes, lubricating oils, plastics, grease, petroleum coke, asphalt of roads. Oil is used in all of those processes. So I do like that as a general in nature comment to have a look at some oil tickers.
Yeah, and it's just, it may not be for the growth aspect of it, obviously, but you don't buy oil necessarily for growth, right? You buy it because it's a good investment. It gives dividends. It's a bit secure. These people make money. There's no question about that. So I would definitely say it's good topic to explore there, because people looked at oil in 2020 and nobody wanted to buy it. They didn't want to buy it in 2021 either. And it was a huge missed opportunity. So,
Yeah, I missed it.
don't listen. Yeah, I mean, everyone missed it. I sold too soon. I'm crying because I had Chevron. I was like,
that's
yes.
a beauty.
Yeah, I bought Schlumberger as well, and the other one, and I had them for a while, and I sold them when they went up, like 30-40% ish, and I was like, hey, I'm done. And then I was like, so the blue chips betrayed me. But that's the point. There is, you could buy SPY, but there's also these other good companies that people kind of, they get a bias, and they wanted to buy Tesla, and everyone did, and that worked out great. But oil worked out good as well.
That's it, mate.
So,
And there's always another opportunity on the horizon. So
absolutely.
I think that's good. We can leave it there. Thank you for joining Wiz and I on We Hate Money, episode 4, and we'll be back again next week. I think oil is a really good topic. If I got my brain ticking over, I want to go look at some stocks.
Yeah, let's dig into that next week.
Cheers, Wiz. Thanks for the chat, mate.
Yeah, you too.
See you next week, all.